Index fund investing. Why it's the best strategy for most people. Why try to beat the market when you can own it? Most investors dream of picking the next Amazon or Tesla before it skyrockets. But let's be real. Outperforming the market is incredibly difficult, even for professionals. That's why index fund investing is the best strategy for most people. 1. What is index fund investing? An index fund is a type of investment that tracks a market index, such as S&P 500, top 500 U.S. companies, Dow Jones Industrial Average 30 blue-chip stocks, NASDAQ 100, tech-heavy index, Total Stock Market Index, entire U.S. stock market. Instead of picking individual stocks, you own the whole market, automatically diversified and historically one of the safest ways to grow wealth. 2. Why index funds outperform most investors. Consistently beating active investors. Over 90% of actively managed funds fail to outperform the S&P 500 over 20 years. Lower fees, more profits. Index funds have ultra-low expense ratios, are 0.03%, while mutual funds charge 1 to 2% or more. Over decades, lower fees mean thousands of dollars more in your pocket. Built-in diversification. Instead of betting on a few stocks, you spread risk across hundreds or thousands of companies. Set it and forget it. No need to time the market or pick stocks. Just invest consistently and let compound interest do the work. Warren Buffett recommends it. Even Buffett advises most investors to just buy an S&P 500 index fund and hold long-term. 3. How to invest in index funds, step by step. Step 1. Choose a brokerage. Popular platforms, Vanguard, Fidelity, Charles Schwab, or M1 Finance. Step 2. Pick an index fund. Vanguard S&P 500 ETF, VOO, or Fidelity Zero. Large Cap Index, FNILX, for U.S. stocks. Total Stock Market Index, VTI, or FSROX, for broader diversification. International Index Fund, VXUS or IXIS, for global exposure. Step 3. Invest regularly. Dollar cost averaging. Invest every month, whether the market is up or down, to smooth out volatility. Step 4. Hold for the long term. Let compound growth work its magic. No panic selling. 4. How much can you make with index fund investing? If you invest $500 per month into an S&P 500 index fund, after 10 years, $100,000. After 20 years, $350,000. After 30 years, $1,000 assumes a historical 8-10% average return. 5. Who should use index funds? Beginners. Easiest way to start investing. Busy professionals. No need to analyze stocks daily. Long-term investors. Best for building generational wealth. Retirement savers. Ideal for 401k and IRAs. Final thoughts. The easiest path to wealth. Index fund investing is the ultimate lazy wealth-building strategy. It's simple, cheap, and more effective than stock picking for most people. Stop gambling. Start growing.